So what is the purpose of financial statement analysis? It's used to make informed decisions about a company. So who performs it? Creditors use it to decide if they should allow a company to buy from them on account, and investors use it to determine if they should invest in the company. Investors and creditors cannot evaluate a company by examining only 1 year's worth of data. This is why most financial statements cover at least 2 periods. In fact, most financial analysis covers trends of 3 to 5 years. This chapter shows you how to use some of the analytical tools for charting a company's progress through time. To do that, we need some way to compare a company's performance not only from year to year, but also within a competing or with a competing company and with the industry. So our first learning objective is to perform a horizontal analysis of financial statements. So here we are looking at Verifying Design's income statements. Now these are comparative income statements, so they're comparing 2 different years side by side. It's called horizontal analysis because we are comparing 2 numbers side by side as in a horizon. And in this example, we're comparing 2 financial statements, the income statements, to determine dollar changes and percentage changes. So here's our dollar change column, and here's our percentage change column. So now we're going to figure out how to calculate percentage change. So there are 3 different formulas. They're all basically the same thing, but they're different ways to look at the formula. So the first one is the dollar change divided by the base period, and the base period is just the prior year balance of whatever percentage change you're trying to figure out. Another way to look at it is instead of saying dollar change, the way you calculate the dollar change is its current year balance minus the prior year balance divided by that base period, which remember is the prior year. My students' favorite way to remember this formula is just new minus old divided by old. New is this year's data, old is last year's data, and then you just divide by last year's data. And then you multiply by 100 and attach a percentage sign to it. So we're going to get some practice calculating the percentage change in revenue. So this company's revenues went from 1,466 to 3,189. So we want to calculate 2 things: the amount of change and then the percentage of change. So here's our 3 formulas, 3 versions of the same formula. So we're going to do the top part of the equation, top part of the fraction, and it's dollar change. So the dollar change is the new year, 2014, minus the old year, 2013. So the amount of change is 1,723. So now we have the dollar change, or new minus old, on top, 1,723. And now we're just going to divide by the old year, the prior year, 1466. And when you do the math, you get a percentage change of 117.5%. And the 0.5 is assuming we're rounding to 1 decimal. Now, knowing the percentage change over time is more important than the amount of change.